Imagine being able to buy an entire stock market with a single investment. Today, that idea feels completely normal. Millions of investors around the world use exchange-traded funds, or ETFs, every day. But just a few decades ago, this concept sounded almost impossible. The journey of ETFs is a fascinating story of financial innovation, persistence, and changing the way ordinary people invest forever. Before ETFs existed, investors had two main choices. They could buy individual stocks one by one, which required research, time, and often a significant amount of money. Or they could invest in mutual funds, which offered diversification but came with limitations. Mutual funds were priced only once at the end of the trading day, meaning investors couldn't react instantly to market movements. As financial markets became more sophisticated during the 1980s, many experts started wondering if there could be a better solution. The dream was simple but incredibly difficult to achieve. What if someone could create a single investment that held dozens or even hundreds of stocks while still trading on the stock exchange just like a normal share? Investors would enjoy instant diversification while also having the flexibility to buy and sell throughout the trading day. It sounded revolutionary, but turning that vision into reality required solving complex legal, technical, and financial challenges. The first serious attempts appeared during the late 1980s. Financial firms experimented with products designed to track major market indexes. Some early versions showed promise, but regulatory concerns and legal complications prevented them from becoming long-term successes. These failures, however, provided valuable lessons. They revealed what investors wanted and what regulators expected from such products. Everything changed in the early 1990s. In 1993, the world's first successful modern ETF was launched in the United States. It was designed to track the performance of the S&P 500 index, allowing investors to gain exposure to 500 of America's largest companies through a single security. Unlike mutual funds, this new investment traded continuously during market hours. Investors could buy it in the morning, sell it in the afternoon, or hold it for years. The financial world had entered a completely new era. At first, many people were skeptical. Some investors believed ETFs were just another short-lived financial experiment. Others preferred traditional mutual funds because they were already familiar with them. But as more people experienced the convenience, transparency, and relatively lower costs of ETFs, their popularity began to grow steadily. One of the biggest reasons behind the success of ETFs was diversification. Instead of depending on the performance of one company, investors could spread their risk across an entire market, industry, or sector with a single purchase. This approach reduced the impact of any single company's poor performance while making investing simpler for beginners. Another major advantage was transparency. Most ETFs regularly disclosed what the assets they held, allowing investors to know exactly what they owned. Combined with lower management costs compared to many actively managed funds, ETFs became an attractive option for long-term investors looking to build wealth efficiently. As technology improved and investor demand increased, the ETF industry expanded rapidly. New ETFs began tracking international markets, government bonds, commodities like gold, real estate, technology companies, healthcare, renewable energy, and countless other investment themes. Suddenly, investors had access to opportunities that were once available mainly to large financial institutions. Institutional investors embraced ETFs. Hedge funds, pension funds, and investment managers found them useful for managing portfolios, reducing costs, and quickly adjusting market exposure. What started as a product for broad market investing gradually became an essential tool for both professional and retail investors. Today, ETFs manage trillions of dollars in assets worldwide. They have transformed investing by making diversified portfolios more accessible than ever before. Whether someone is saving for retirement, investing for long-term growth, or building wealth gradually, ETFs have become one of the most widely used financial instruments in modern markets. The birth of exchange-traded funds wasn't just the creation of another investment product. It represented a fundamental shift in financial history. It combined the diversification of mutual funds with the flexibility of individual stocks, opening the doors of investing to millions of people around the globe. What began as an ambitious idea in the late 20th century has grown into one of the greatest innovations in the history of financial markets, proving that sometimes the simplest ideas have the power to change the world forever.